A ticking financial crisis is quietly developing in Washington, not due to Beijing's military or cyber capabilities, but because of the bond market. Within just 3 days, Treasury yields surged past 4.5%. Foreign buyers withdrew from bond auctions, and anxiety spread from Wall Street to trading desks worldwide. Then, unexpectedly, the White House reversed its position on China tariffs, without public statements or negotiations, just a sudden and silent retreat. Why? Because rumors suggested Beijing might be preparing something far more destabilizing than sanctions: a massive sell-off of US treasuries. While this might sound like speculation, there are already signs of this possibility. The White House's tariff rollback on April 9th wasn't a gradual shift, but a sharp and immediate one. Electronics, machinery, and even electric vehicle components were quietly removed from the tariff list. The official reason was to ease inflationary pressures on US households. But sources told Bloomberg that the true catalyst was a sudden 28% drop in foreign participation at a Treasury auction just days earlier. The yield on the 10-year Treasury had reached 4.5%, nearing the 5% mark that caused regional banking instability last year. Treasury Secretary Janet Yellen reportedly held an emergency call with Beijing's diplomats, an unusual step that coincided with the tariff rollback. According to J.P. Morgan's Phoebe White, the administration had lost control over the bond market narrative. While the White House viewed the move as necessary, the bond market saw it as a sign of panic. While Washington's primary concern focuses on China, Japan has already acted decisively. In February 2025, Japan sold a record $36.6 billion worth of US Treasuries, its largest single-month sale in over 10 years. This move was driven not by ideology, but necessity. The Bank of Japan had abandoned its yield curve control, forcing Japanese institutions to sell US debt to stabilize their own markets and protect the yen. If an ally like Japan is selling off US debt, what should the world make of China's silence? As of March 2025, China's holdings of US Treasuries had dropped by over 30% since 2018, standing at $775 billion. Although China hasn't yet initiated a full-scale sell-off, it doesn't need to. As Barclays' A.J. Raja noted, the weapon isn't the sale itself, but the looming threat. The mere possibility of it creates uncertainty. When the 10-year Treasury briefly hit a yield of 4.96% on March 27th, it triggered a chain reaction. Credit markets froze, mortgage rates shot past 7.8%, corporate debt spreads widened by 52 basis points overnight, and regional bank stocks fell by an average of 6.2%. According to Goldman Sachs, the deeper issue is the rising cost of debt servicing. With US debt surpassing $36.2 trillion, each 1% increase in yield costs the US government roughly $346 billion annually. The Congressional Budget Office now projects that by mid-2025, debt servicing will exceed defense spending. In Q1 2025 alone, debt servicing cost $273 billion, more than all Medicaid spending combined. BlackRock traders warned clients that if yields rise past 5%, the Federal Reserve might be forced into unplanned intervention, which could risk undermining the dollar and reigniting inflation. In this context, the tariff rollback wasn't just political, it was about survival. The Federal Reserve now faces a dilemma: defend the dollar or provide liquidity to struggling markets. Tightening would lead to even higher yields, while easing could weaken the dollar further. With the Fed's balance sheet already swollen at $744 trillion, its options are limited. In the first quarter of 2025, the Fed reported $142 billion operational loss due to interest payments exceeding its income from assets. If another financial crisis erupts, emergency liquidity injections could force the Fed to expand its balance sheet further, just as Congress debates fiscal ceilings and deficit caps. Former Treasury official Stephen Ratner described the situation as triage rather than monetary policy, indicating that the Fed is now propping up both the banking sector and the US government. The question isn't whether the Fed can act, but whether markets will continue to trust it when it does. Amid this turmoil, foreign investors are increasingly looking to other options. In the first quarter of 2025, German bonds saw an influx of $76 billion, up 41% from the previous year. Investors are not seeking higher yields, but rather credibility. With the US bogged down in political gridlock and Japan focusing on its own currency, European bonds, especially German ones, are becoming seen as a more stable alternative. The US dollar, in turn, has lost ground, with the dollar index dropping by 3.8% since January. Central banks, from Brazil to the UAE, are shifting reserves away from the dollar, opting for the euro or the yen. According to the IMF, global dollar reserves fell to their lowest level in nearly 30 years in March 2025, standing at 57.1% of allocated reserves. The dollar is no longer the automatic safe haven in a crisis. It has now become a volatility amplifier. Meanwhile, China is pushing for alternatives like the digital yuan and new trade systems that bypass the dollar, accelerating the shift away from dollar dominance in global trade. Amid these tensions, Apple's recent tariff exemptions were both strategic and revealing. While many US companies were forced to adjust their sourcing strategies, Apple quietly secured waivers for Chinese-made components critical to its iPhone 17 launch. Apple's dependence on Chinese tech remains significant, with over 60% of its global assembly still done in China, and nearly 95% of its silicon packaging routed through Jiangsu and Guangdong. Tim Cook's February 2025 visit to Beijing was not merely ceremonial, it was transactional. According to insiders, Cook warned US policymakers that a full decoupling from China could cost Apple up to $21 billion in relocation expenses and disrupt its entire 2025 product line. This wasn't just a favor to China. It was an acknowledgement that some American companies are too integrated with China to easily decouple. The impact on US households is also severe. According to the Federal Reserve's March 2025 data, 37% of Americans cannot cover a $400 emergency expense without borrowing or selling assets. When tariffs on Chinese goods were increased between 2018 and 2019, the Tax Foundation estimated a net cost of $831 per year to US consumers. However, with inflation eroding purchasing power, that burden has become even heavier. In 2024, real wages shrank by 1.3%, while inflation pushed prices up by 3.7%, wiping out much of the savings people had accumulated during the pandemic. Full tariffs on electronics, textiles, and automotive parts could increase prices by an average of 12.4%, further pressuring households. According to the Bankrate 2025 report, 61% of consumers are already cutting back on discretionary spending due to cost pressures. Trade wars may target China, but they hit American wallets first, and there is less room to absorb the blow this time. Internally, the US government is divided on trade policy. Within a span of 6 weeks, the administration proposed new tariffs on Chinese electric vehicles, rolled back existing levies on industrial components, and criticized Apple for its reliance on Chinese tech, all while exempting the company from tariffs. A leaked memo from the US Commerce Department revealed internal disagreement over how to handle tariffs. One faction advocates for more aggressive decoupling from China, while another, backed by Treasury and Federal Reserve advisors, warns that escalation could destabilize already fragile markets. The disjointed approach is being interpreted as erratic, not strategic. Economist Eswar Prasad of Cornell noted that tariffs have become reactive measures rather than part of a coordinated strategy. Markets lose confidence when policies appear improvisational, and allies may also lose trust when they see this unpredictability. The political consequences are significant. Trump's approval among independent voters has dropped to 39%, the lowest since his return to office. At the same time, the Conference Board's leading economic index has fallen for 14 consecutive months, signaling a higher than 50% chance of a recession by the second half of 2025. Goldman Sachs has downgraded US GDP growth to just 1.2% for Q3, citing trade instability and deteriorating business investment. Key industrial states like Wisconsin, Pennsylvania, and Michigan are already seeing auto layoffs tied to soaring raw material costs from tariff threats. If these economic strains drag the US economy into a recession, the political fallout could mirror the realignment seen after the 2008 financial crisis. Sources close to the administration have suggested that further tariff rollbacks are under discussion, but timing them without appearing weak remains a core challenge. The real question isn't whether the US will reverse course again, but whether global markets will wait long enough for the US to act. Washington can soften tariffs, delay Treasury auctions, and pressure the Fed, but it can't stop the shift already underway beneath the surface. China's move away from the dollar system continues as Beijing builds a new financial system through energy trade, commodity settlements, and state-backed digital infrastructure. So, if you think the latest tariff reversal marks the peak of US-China economic conflict, you might be missing the real battlefield unfolding behind the scenes.